In this video, guys, we're going to have a simple guide to stop loss orders and how to enter the market with a stop. Stay tuned. Hey traders, warm welcome to you. Alright, so I did a video a while ago where I talked about stop loss orders and also how we can use stop loss orders to enter the market if you want to enter a position. However, I don't think I did a good enough job of being clear about what I was talking about. So I'm going to redo it now. I'm going to have a quick guide now. I'm going to talk about what's a stop loss and how we can enter the market using a stop. Now, the confusion perhaps does start from the name of the order. So if we are long something, and we'll look at a short example in a moment, but if we are long something, let's look at both so we can get it in our minds. If we're long something, let's say we bought it at 100, but let's say we don't want to have the trade when it goes under 80. We have a stop loss sell order at 80. It means it stops the loss of the trade under 80. So the trade automatically is closed at 80. All right, and that's why they're called stop loss orders or stop order generally. From the short side perspective, let's look at this chart here. Let's say we're short at 50. Let's say we're short at 40. Okay, whatever that may be, why we've done that, we're short of 40 and we don't want it to go above 50. Okay, short of $40, don't want it to go above $50. You could be a currency pair shorting it at 40, don't want it to go above 50, 10 pip stop, whatever it may be. Then you would put a buy stop in and that would stop the loss of the trade going against you if it hit 50. So as the price goes up, takes 50, it would buy your position because you know to cover a short, you just buy, and that means that you're net neutral in the position. And I think we grasp that. Now, the problem comes when we kind of look at getting into the market with a stop, because it becomes a little bit confusing from a perspective of why is it called a stop? Well, a stop, the main reason for the stop is exactly that. It's to get yourself out of the market for a trade you're already in. However, you can use a stop to get into the market. I want you to forget for the moment that it's called a stop, even though I'm going to reference it to a stop. Forget stop as in to stop anything. That's just a terminology, the name of the order type for now. So forget that it comes from stop loss, just that's the order type. So we've got a stop and we've got a limit. Now, if we were in this scenario here, okay, and let's say we wanted to go long, okay, we wanted to go long on this position. Now, it's exactly the same chart, right? If the market went up and hit that level, what would happen? Now, regardless of anything else, the same chart, if the market comes up and hits that level, if we've got a buy stop, and it's a buy stop, let's not forget because we're going short, it's a buy stop. If the market comes up to that level, the order will be executed regardless of the position we've got already. Okay, so if we've got a buy stop at 50, if the price comes up to 50, chug, 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 the buy stop will be executed. In this example, it's still going to be executed, but we've already got a short position, so that makes us net neutral. That's the traditional stop of taking us out of the trade. We have exactly the same order here. However, in this instance, we don't have a short position. So what does it do? The buy stop comes in, it triggers the buy at 50, exactly the same as this one. But instead of cancelling out our short position, we've now got a long position because we didn't have anything in the first place. So it executes exactly the same order, but it just leaves us net long. So we can use this to get into a trade that we'd like to get into that we perhaps won't be at the screen for. We don't want to buy it unless it gets there, all sorts of other reasons. So I'm going to rub this off the board and I'm going to look at two scenarios where we might actually want to use this. Okay, so let's have a look at scenarios. So we've got a market scenario here, right? We've got a range bound condition and we want to buy, but we only want to buy if it breaks out of that range, right? So under normal, we've got a couple of options. If the market, let's say the market is sitting right here, right now, okay? If we used a limit order, the limit order would limit buy. I'm gonna stick on the buy side here, guys. So buying, everything here is a buy for this example. And we just flip on its head for a short, but let's keep it for a sell. Let's just keep it now for buy. So we can buy, if we wanted to buy below the market, we'd have to use a limit order, right? If that current market market, let's use it as easy and say it was at 50. If we wanted to buy at 40, we'd have a limit order in at 40, right? The market would have to come down to our price. Now, if this is 60, for example, up here, we can't use a limit at 60 because it's higher, we're buying higher. So we'd use a stop. And again, forget about the loss scenario of stop and just, it's a stop order. And what does that mean? That basically means that as the price gets to that level, a buy order is sent to the market, which would make us net long. Because we haven't got a short in the first place, this would make us net long. So if we wanted to buy only if the market started to break out of that range, then that's what we do. We're putting an order that says, hey, if the market gets to this position, then please buy me some. And that happens to be a stop order, because if we were already short, it would stop our loss. But in this case, because we're not sure, we want to get long into the position as it goes above a high, it would just enter us into the market long, and we would have a net long position there. So you can see, you could potentially, if you forgot about this limit that we had down here, you could potentially bracket this and say, well, actually, I don't want to get involved unless we break the range. But to do that, I want to be sure if we break this range, it would be a sell stop. If we've got no position already, I'd go short when that sell stop was activated. I would have a buy stop here, and I'd go long if we broke out the range. You don't know which way the range is going to break. You just know that you want to be in it if the range breaks, so you could just use that. Again, this is exactly the same order is executed. Exactly the same thing happens, regardless of whether you have a position beforehand or not. But in this circumstance, you don't have a position beforehand, so this gets you into the market. If you had already a short position and that got activated, of course, that would cancel out your short. Let's say we're short 10 lots, £10 a point, whatever it may be. You got to stop for £10 a point. It would buy, it would make your position zero. If you didn't have that short position, it would still buy and make you long £10 a point. Same with this way. If you had a long position for £10 a point, came down, the stop would sell into the market because you have a sell stop below. That will cancel out your position and stop the loss going any further. If you didn't have a position already and it came down through that level, exactly the same thing would happen. It would be triggered. You would be short £10 a point because there'd be nothing to offset it. So you can use this stop to get into or out of the market. I know it's why it's called a stop, because most people use it to stop the loss, but it can still be used to get in if you want to get in above, along, below on a short. All right, guys, take care. See you next one. Bye-bye.